Imagine pulling in $181.5 billion in just 90 days.
It's just a staggering amount of money.
Right. You are running this massive commercial empire, and money is flooding in at a rate of roughly $2 billion every single day.
Which is hard to even wrap your head around.
Yeah, but here is the crazy part. When you check the corporate bank account at the end of the year to see your free cash flow, almost all of it is gone.
Poof, just gone.
Exactly. And that's not some hypothetical scenario. That is exactly what is happening right now with one of the most closely watched companies on the planet. Welcome to the Time and Market Deep Dive. We have a massive paradox to unravel for you today.
We really do.
Okay.
But before we get into the weeds, a quick piece of housekeeping.
Right. A reminder to you listening, this deep dive is strictly for entertainment and educational purposes. We are here to break down the data and the strategy, but you should always seek professional financial advice before making any investment decisions for your own portfolio.
Yeah, we can give you the map and show you the road conditions, but, you have to be the one driving your own car.
Love that analogy. So let's unpack this. Our focus today is entirely on ticker symbol AMZN, Amazon. And the paradox I just mentioned, well, it comes straight out of their newly released Q1 2026 earnings report.
Yeah, the top line numbers are just, they're staggering.
We are talking about $181.5 billion in quarterly revenue.
Which is a 17% increase year over year. I mean, for a company of Amazon's sheer size, finding a way to grow 17% in a single quarter is a monumental logistical feat.
It really is. But the bottom just completely drops out when you look at the free cash flow for the trailing 12 months. It absolutely plummeted.
Right.
I mean, a year ago, they were sitting on nearly $26 billion in free cash flow. Today, that number has collapsed to just $1.2 billion.
That's a 95% drop. And if you are an everyday retail investor scanning a balance sheet and you see free cash flow evaporate by 95%, your immediate instinct is usually just panic.
Oh, absolutely.
Because free cash flow is the lifeblood of a business, right? It's the money left over after paying for operating expenses and capital expenditures. It's the cash you use to pay dividends or buy back stock or buffer against a recession.
Right. So seeing that number drop to near zero makes it look like the company is just bleeding out. So our mission today is to figure out where that money went.
Yes, follow the money.
We need to look under the hood of Amazon's various businesses, from the cloud infrastructure to those, brown boxes arriving on your porch. And by the end of this conversation, we are going to synthesize all this data to give you a clear verdict on whether Amazon is a buy, a hold, or a sell for your portfolio.
And to get to that verdict, we really have to start by establishing exactly where Amazon stands today. We need a snapshot of their performance and how the broader market is valuing them. Because you can't really understand the cash train until you understand the current expectations baked into the stock.
Okay, so let's look at the stock price and the performance. We are sitting here in April 2026, and the stock is hovering right around the $262 to $263 range.
Right. And if we look back, 2025 was a phenomenal year for their stock performance. The broader tech sector had a massive run-up, and Amazon rode that wave beautifully. But so far in 2026, the performance has been a bit more muted.
Yeah, it's kind of flatlined a bit this year.
Exactly. It's plateauing as the market tries to digest these new earnings numbers.
So let's talk about the valuation and key multiples. If the stock is at $262, what does the PE ratio, the price to earnings ratio, actually look like?
Well, currently, their trailing PE ratio is sitting right around 45.
Okay, 45, which for a normal company sounds incredibly expensive.
It does. But we have to compare it to their 5-year average. Historically, Amazon always trades at a premium. Their 5-year average PE is actually closer to 60. So, surprisingly, relative to its own history, it's trading at a slight discount.
Interesting. And what about the forward PE? Like what analysts expect them to earn over the next 12 months?
The forward PE is looking much more attractive, dropping down into the mid-30s, around 35 or 36. So the market is pricing in some significant earnings growth despite the current cash burn.
That makes sense. And if we look at our sources, Morningstar has assigned Amazon a fair value estimate of exactly $260 per share.
Right. They gave it a 3-star rating.
Which basically means they view the stock as perfectly fairly valued. It's trading at $262, and the fair value is $260. The market is not offering a discount here at all.
No discount whatsoever. They also highlight the enterprise value to sales multiple, which is currently sitting at 3 times.
Okay, let's pause and translate that because I know it can sound like alphabet soup to a lot of people.
Yeah, let's bring it down.
When we talk about an EV to sales multiple of 3, enterprise value is basically the entire price tag of the company if you wanted to buy it outright. So that's market cap plus debt minus cash. The sales are just the revenue.
Exactly.
So an EV to sales multiple of 3 means you, as an investor, are paying $3 for every $1 of sales Amazon makes. In the traditional retail world, like if you look at Walmart, paying 3 times sales would be outrageously expensive. Walmart usually trades at less than 1 time sales.
Right. But in the tech world, 3 times is fairly standard. And that distinction is vital. It shows the market is treating Amazon like a high-margin tech company, not a grocery store.
Okay, but we really need to dig into the intrinsic value ourselves. We can't just take Morningstar's word for it. So let's actually conduct a 10-year discounted cash flow analysis, a DCF, right here.
Let's do it. A DCF is the best way to cut through the noise and figure out what the underlying business is actually worth.
Right. But to do a DCF, we have to project out their free cash flow for the next 10 years and discount it back to today. And we just said their current free cash flow is only $1.2 billion. If we use that as our starting point, the valuation would be, well, terrible.
It would be functionally zero. But you can't use that $1.2 billion because it's artificially depressed by a massive one-time spike in capital expenditures. So for our analysis, we have to specify a normalized free cash flow base.
Okay, what base are we using?
We're going to use an adjusted base of roughly $48 billion. That represents Amazon's actual structural cash-generating capability before they started dumping money into this new AI infrastructure build-out.
Got it. So we start with $48 billion. Now, what's our growth expectation?
We are going to perform this 10-year DCF using a 9% growth expectation.
9% growth on free cash flow every year for a decade. That's solid, but not overly aggressive for Amazon.
Exactly, it's conservative. And then for the terminal value calculation, which is basically what the company's worth after year 10, into perpetuity, we use a 2.5% terminal growth rate.
Which roughly mirrors long-term global GDP growth.
Right. And to bring all those future billions back to today's dollars, we are applying a standard 10% discount rate.
Okay, so 10 years, 9% growth, a $48 billion base, 2.5% terminal rate, and a 10% discount rate. When you crunch all those numbers together, what does the final calculated intrinsic value come out to?
The math spits out an intrinsic value of right around $258 to $260 per share.
Wow. Okay, so our own DCF perfectly aligns with Morningstar's estimate.
It does.
So buying Amazon stock right now is like buying a luxury home exactly at its appraised value, knowing the inspection came back flawless. You aren't getting a bargain, you are paying a premium for a premium asset. But the danger is that it's priced for perfection. If the roof leaks tomorrow, you're immediately underwater because there's zero margin of safety. Which brings me to the core question. If it's already priced to perfection today, where does the future upside actually come from?
Well, the upside comes entirely from a capital expenditure plan that is so massive, it almost breaks modern financial modeling. Amazon is currently executing a $200 billion CapEx plan for the year 2026.
Wait, $200 billion?
Yes.
In a single year?
In 12 months.
And there it is, the $200 billion elephant in the room. That completely explains where the $26 billion in free cash flow vanished to?
It does. A $200 billion spend in a single year is a 60% increase from what they spent in 2025. To put that in context, Amazon is spending more money on capital expenditures in 12 months than the entire gross domestic product of many developing nations.
I mean, I have to push back on this strategy. Because as an investor, when I see a company suddenly hike its capital spending by 60% to chase a tech trend, my alarm bells ring. It looks like pure FOMO, fear of missing out.
Sure, it looks like a panic move.
Right. Every tech company is terrified of being left behind by artificial intelligence, so they just throw an ocean of cash at it. How do we know this isn't just a massive cash bonfire? They're building massive data centers, buying proprietary chips, laying down high-speed networking, but what if the demand doesn't actually materialize?
That is the exact fear driving short-term anxiety on Wall Street right now. But Amazon's CEO, Andy Jassy, has a very specific framework for this. He describes the AI market using a barbell analogy.
Okay, walk me through the barbell.
Think of a heavy barbell at the gym. On one end, the heavyweight represents the massive AI research labs, the companies building the foundational models who need raw, unfiltered computing power. On the opposite end, you have enterprise companies doing very basic automation, like writing emails or summarizing documents. Jassy argues that the handle of the barbell, the thick, heavy center that connects the two ends, is the real, untapped gold mine.
Okay, what does that center handle actually represent in the real world?
Core enterprise workloads. We are talking about the mission-critical applications that keep Fortune 500 companies running. Supply chain management, complex human resources routing, real-time dynamic pricing.
Oh, the boring but essential stuff?
Exactly.
Right.
Jassy's pointing out that the vast majority of these massive corporate operations haven't even begun to migrate to AI yet. Amazon is spending $200 billion today so that when thousands of global corporations finally decide to flip the switch and move their core operations to AI, AWS is the only cloud infrastructure big enough and fast enough to catch them.
I see the logic, but build it and they will come is a very expensive gamble. Do they actually have clients signing the dotted line today to justify pouring $200 billion into concrete and servers?
They do, and the scale of the commitments is staggering. They have secured major external AI partnerships. Anthropic, which is a leading AI lab, has committed to buying over $100 billion in AWS compute power over the next decade.
$100 billion from one client?
Yes, and OpenAI just committed to consuming 2 gigawatts of capacity through AWS infrastructure starting in 2027.
2 gigawatts. We are literally measuring computing contracts in gigawatts now, like it's a power plant.
It's unbelievable.
Think about what a gigawatt actually means. 1 gigawatt is roughly enough electricity to power 750,000 average homes. OpenAI is contracting enough raw electrical capacity to power a major metropolitan city just to run their AI models.
Which perfectly illustrates why Amazon needs to spend $200 billion. You cannot host that kind of energy demand on legacy infrastructure.
But the infrastructure itself is changing, right? Amazon isn't just taking this $200 billion and handing it all to NVIDIA to buy off-the-shelf graphics cards.
Not at all. And that is the secret weapon embedded in this CapEx plan. Amazon is vertically integrating. They are designing and deploying a highly lucrative ecosystem of custom silicon. They have their own proprietary chips: Trainium, Graviton, and Nitro.
This reminds me of when Amazon realized relying on UPS and FedEx was too expensive and too much of a bottleneck, so they just decided to manufacture their own fleet of delivery vans and build their own logistics network.
Yes.
They are applying that exact same playbook to the cloud. They don't want to be reliant on NVIDIA.
The comparison is spot on.
Yeah.
And the financial results of that silicon division are already materializing. Amazon's custom chips have crossed a $20 billion annual revenue run rate. And more importantly, that segment is growing at triple-digit percentages year over year.
Growing at over 100% when you are already making $20 billion is almost unheard of. How are they doing that?
By fundamentally building better hardware. They recently highlighted their Trainium 3 chip, which is built on TSMC's 3-nanometer process.
Let's explain why the 3-nanometer detail matters, because it sounds incredibly technical.
Yeah, it's deep in the weeds.
A nanometer is absurdly small. A human hair is about 80,000 to 100,000 nanometers wide. In chip manufacturing, the 3-nanometer process refers to the size of the transistors on the chip. The smaller the transistors, the more you can pack onto a single piece of silicon. And when transistors are closer together, the electrical signals don't have to travel as far.
Which means the chip operates significantly faster while requiring less electricity and generating far less heat.
And heat is the enemy of a data center. If you are running 2 gigawatts of power, cooling those servers is one of your biggest expenses. By using 3-nanometer chips, Amazon structurally lowers their electricity and cooling bills.
Exactly. They offer 4 times the performance of their previous generation. And the biggest players in the world are adopting it. Meta is currently deploying tens of millions of AWS Graviton cores to power their own agentic AI efforts.
And just to clarify, agentic AI, for you listening, this isn't just a chatbot that answers your questions. Agentic AI acts as an autonomous agent. You tell it a goal, and it goes out and executes tasks across different software. It books the flight, it writes the code, it negotiates a supply contract. It requires massive continuous computing power.
Right. And Anthropic is doing the same thing, securing up to 5 gigawatts of Trainium chips to train their advanced models. This custom silicon provides a massive strategic moat. Right now, the tech industry is severely bottlenecked by NVIDIA's pricing power.
Right, NVIDIA chips are great, but they are so expensive.
Extremely expensive. By building Trainium and Graviton, Amazon drastically reduces their reliance on NVIDIA hardware. It also allows them to compete directly against Google, who has their own custom AI chip, the TPU. If Amazon could walk into a Fortune 500 boardroom and prove that Trainium lowers their AI training costs by 20% compared to standard hardware, they lock that client into the AWS ecosystem for a decade.
Okay, let's pull back from the server racks for a minute. The reality today is that AWS and this custom silicon division are vacuuming up all the free cash flow. $200 billion has to come from somewhere. How is Amazon actually keeping the lights on today?
The everyday cash flow is being driven by what analysts are calling Amazon's second engine of growth, combined with the sheer gravity of Amazon Prime.
The second engine being their advertising business.
Yes. In Q1 alone, Amazon's advertising revenue hit $17.2 billion. That's up 24% year over year.
We have to talk about the margin profile here because $17.2 billion in advertising is very different from $17.2 billion in retail sales.
Completely different.
If Amazon sells you a couch, they have to buy the materials, manufacture it, store it in a massive warehouse, put it on a truck, pay a driver, and physically deliver it to your door. The profit margin on that couch is tiny, but if a company pays Amazon to place a sponsored product at the top of your search results, well, the cost of serving those digital pixels to your screen is essentially zero.
The marginal cost of production is virtually non-existent. That means the vast majority of that $17.2 billion falls cleanly straight to the bottom line as pure profit. It is a massive cash generator acting as the financial bridge to fund these futuristic AI data centers.
It is a brilliant irony, isn't it? The company that defined itself by putting physical goods into brown cardboard boxes is now relying on high-margin digital ads to fund the AI revolution.
It really is.
But those ads are only valuable if people are actually on the website looking to buy things, which brings us to Prime.
Prime is the foundation of the entire advertising model. Our sources point out that Amazon has over 200 million global members.
Wow.
To put that scale in perspective, if Amazon Prime were a sovereign nation, it would be the 8th largest country in the world by population.
The penetration in the U.S. market is unbelievable. 81% of internet users aged 18 to 34 have a Prime membership. It's not a subscription service anymore. It's basic digital infrastructure for an entire generation.
And it drives incredible purchase behavior. The data shows that a Prime member spends an average of $1,400 a year on the platform, compared to just $600 for a non-member.
More than double.
The membership more than doubles the lifetime value of the customer, and the primary reason, 90% of them renew. Free shipping.
The logistical moat. But that logistics network is exactly where the company is facing some serious pain right now. While advertising and cloud are booming, the traditional retail business is under significant pressure.
Yeah, retail margins are currently taking a hit due to a brutal combination of tariff uncertainties and highly aggressive competition.
Tariffs are a huge macroeconomic headwind right now. If it costs more to import goods into the country, someone has to eat that cost. According to CEO Andy Jassy, those import costs are already starting to reflect in product pricing.
And to try and protect the customer from immediate price spikes, Amazon has been deploying a strategy called forward inventory.
Which means buying in bulk early. They are purchasing millions of products right now before new tariffs take effect and stuffing them into warehouses. It's a smart long-term move to keep prices low, but in the short term, it ties up billions of dollars in physical inventory. It burns cash.
It absolutely burns cash.
Right.
And they are forced into that defensive posture because the competition for the price-sensitive shopper is fiercer than ever. Walmart is a permanent giant, but platforms like Temu and Shein are reshaping consumer expectations.
Oh, yeah. They ship extremely cheap goods directly from overseas manufacturers to the consumer, cutting out the middleman entirely.
Exactly.
So if tariffs are squeezing margins and Temu is stealing the bargain hunters, it feels like the traditional e-commerce business is actually the least attractive part of Amazon's portfolio right now.
If you look at it strictly through the lens of profit margins, yes, e-commerce is incredibly asset-heavy and low margin. However, structurally, it remains the vital top of the funnel. Without the low-margin retail store, you don't attract the 200 million Prime members. Without the Prime members constantly searching for products, you don't have the captive audience needed to generate $17.2 billion in high-margin advertising.
Ah, so it's an interconnected flywheel. The retail side might be the loss leader, but it spins the high-margin businesses.
Precisely.
That makes perfect sense. So we've mapped out the internal mechanics. The retail store acquires the users, the ads generate the cash, and the cloud division burns that cash to build custom silicon and AI infrastructure. But if we zoom out, how are Wall Street and the competition reacting to this strategy? Let's summarize the current analyst sentiment.
Well, in the cloud war, the competitor landscape is intense. While AWS is accelerating at 28%, Google Cloud is actually going faster in percentage terms right now.
Which makes sense mathematically, right? Google Cloud is working from a smaller base revenue number, so it's easier to post a higher percentage growth. But it also signals that Google might be aggressively undercutting on price to win market share.
It is a knife fight between Amazon, Microsoft, and Google for AI dominance. But Wall Street analysts are largely looking past the short-term competition and the cash burn. Goldman Sachs recently raised their price target on Amazon to $290.
$290, okay.
They are highly bullish on what they call the dual driver structure, meaning they believe the combination of AWS accelerating and advertising margins expanding will lift the entire valuation of the company. Morgan Stanley also maintains an overweight rating, viewing Amazon as the most direct beneficiary of the enterprise AI build-out.
However, there is a regulatory shadow hanging over all of this that we have to discuss. The sources note that Microsoft is actively exploring legal remedies regarding Amazon's $50 billion investment into OpenAI.
This is a fascinating subplot. Microsoft spent years and billions of dollars intertwining themselves with OpenAI. Then Amazon steps in, leads a massive $110 billion funding round, and writes a $50 billion check.
Just flexing their cash?
Totally.
Yeah.
And Microsoft views that as a direct threat to their influence and perceived exclusivity over OpenAI's technology.
Which brings up a terrifying scenario for an Amazon investor. The entire justification for this $200 billion capital expenditure plan relies heavily on fulfilling these massive gigawatt contracts with Anthropic and OpenAI.
Right.
What happens if the Department of Justice or the FTC steps in? If regulatory agencies decide to block, delay, or significantly alter these partnerships due to antitrust concerns, doesn't that blow a hole right through Amazon's blueprint?
It is arguably the single largest risk factor on the board. Regulatory scrutiny over these massive tech investments often leads to procedural delays that can last years. If Amazon builds out $200 billion in physical infrastructure and then is legally blocked from servicing OpenAI's 2 gigawatts of capacity, that infrastructure is suddenly heavily overbuilt.
You just have empty data centers depreciating in value while lawyers argue in court.
Exactly.
It's a massive multi-billion-dollar risk. So let's bring it all together and deliver on the mission of this deep dive. For the listener trying to figure out what to do with their portfolio, we need to provide a definitive verdict based on the current stock price's discount or premium to our calculated intrinsic value. Is Amazon a buy, a hold, or a sell?
Well, according to the analysis from our sources, the verdict entirely depends on your timeline as an investor.
Okay, let's say I'm looking at a short-term 12-month horizon.
For a 12-month horizon, the verdict is a hold, or a strategy of waiting for weakness.
And the logic there is the margin compression and the fact that it's trading right at its intrinsic value.
Correct. The stock is fairly priced today, right around that $260 intrinsic value we calculated with the DCF. But over the next few quarters, the reality of spending $200 billion on CapEx is going to weigh heavily on the balance sheet. Combined with the tariff uncertainty squeezing retail profits, the stock is highly susceptible to trading sideways, or even dipping if short-term investors get spooked by the expenses.
Okay, but what if I am a long-term investor? What if I am looking at a 3 to 5 year horizon?
If you have a 3 to 5 year horizon, the verdict is a definitive buy.
Why does the math change so drastically over half a decade?
Because over a 3 to 5 year period, you begin to see the compounding effects of these investments. The massive CapEx spending transitions from being a cost burden into a revenue generator as those enterprise AI workloads finally come online.
Right, the barbell handle.
Yes. The structural cost advantages of their 3-nanometer Trainium chips will widen their profit margins against competitors who are still paying a premium for NVIDIA hardware. And the cash flow from advertising will just continue to compound. Our sources view Amazon as a generational winner because they possess a structural moat that almost no other company can match.
That is incredibly clear. If you are looking for a quick return in 2026, you might be frustrated by the heavy costs of their expansion. But if you are willing to endure the short-term pain while they literally build the physical infrastructure of tomorrow, the fundamental math is heavily in your favor.
It is a classic story of enduring short-term margin compression to secure long-term structural dominance.
As we wrap up this deep dive, I want to leave you with one final provocative thought to mull over. We spend so much time analyzing Amazon's battles against corporate competitors, whether it's Microsoft and Google in the cloud or Walmart and Temu in retail. We view the market as a battlefield between corporations.
But the real threat might not be a corporate competitor at all.
Exactly. With government regulators actively scrutinizing their massive investments in AI labs like OpenAI and Anthropic, you have to ask yourself a bigger question. At what point does sheer scale transition from being a company's greatest competitive moat into its biggest regulatory liability? When does being the everything store and the everything cloud simply become too big for governments to allow?
It's the paradox of ultimate success. The wider and deeper you build the moat, the larger the target on your back becomes.
Something to keep in mind the next time you see that Smile logo on a cardboard box. Thank you so much for joining us on this deep dive into Amazon's Q1 earnings. We hope we helped clear the muddy waters of their balance sheet. Keep digging into your own sources, stay curious, and we will see you on the next deep dive.